Britain has decided. Joining me to discuss the decision to leave the European Union is Dominic Rossi, Chief Investment Officer for Equities at Fidelity International. Good morning, Dominic.
Morning, Tom.
So, it's a UK decision, but clearly it has global implications. What, for you, are those global implications?
I think twofold. We're now in the midst of an economic and a political shock. I think the political shock will be greater than the economic shock. We can expect lower growth in the UK and across Europe, and that's now being discounted in equity markets. But probably more important is that political risk premia will now rise around the world, whether it's the presidential election later this year or the French presidential election next year. Investors are going to be far more cautious going into those events.
Clearly, the UK and Europe are at the epicenter of this decision. The implications for markets globally, are they really focused on the UK and Europe, or there's a wider implication?
As I was saying, the fact that now political risk premia will need to rise across all capital markets implies lower valuations for equities, and that is now being discounted as we speak. But you're right, the epicenter is the United Kingdom and in Europe, where particularly the United Kingdom, where I do think we will face a mild recession over the course of this year and early next year, but also because of increased political uncertainty over new government, general election, the future of Scotland. I think the most negative impact will obviously be felt closer to home.
Now, typically the currency market bears the brunt of these kinds of shocks. We've seen the pound fall significantly. Do you think it's got further to go?
I think this morning we have seen the knee-jerk reaction of markets. Markets were poorly positioned for this event. In fact, sterling had been rallying into the last few days. So with markets poorly positioned, I think we're now just seeing the unwinding of that technical position. But I don't think this is the end of it. We have a very substantial current account deficit which needs to be financed. As I said, at a time when political risks in this country are rising rather than falling. So I think as the dust settles and the fundamentals assert themselves, I think it's very likely that sterling will continue to weaken against both the US dollar and the euro.
So, as an investor, how do you position yourself for the type of environment which you envisage us moving into? I
think diversification is always the way to position yourself, particularly when you have black swan events such as this. So one has to make sure one has a balance between sterling and non-sterling assets. Bond markets, I think, obviously will provide a store of value. And there will always be large global organizations with very large balance sheets. Global companies, which in these times will also protect your pensions or your ISAs.
And investors presumably have the opportunity to buy good quality assets at a better price.
Well, as a fund manager, that is what I've done over the past 30 years, is you use very difficult moments like this to buy those sound, sustainable businesses that you've wanted to own, and now you've got an opportunity to buy those stocks at a more favourable price. But it's going to be very, very volatile over the course of the next few months. So it's best to tread carefully rather than one fell swoop.
Dominic, thank you very much indeed.